The largest financial market in human history did not emerge from innovation or genius. It emerged from a legal loophole written in 1999. A single paragraph in a 200-page bill created a $600 trillion shadow that would reshape global finance for decades. The Age of Hedging. In the 1970s, global finance faced a fundamental problem. The Bretton Woods system had collapsed. Currencies now floated against each other. Oil prices quadrupled overnight. Interest rates became volatile. For corporations and banks, this created immense uncertainty. A company borrowing in German marks could see its debt payments double if the dollar weakened. Bank lending at fixed rates could be ruined if interest rates rose. The traditional tools of finance could not manage these risks. This was the environment that gave birth to modern derivatives. The first interest rate swap occurred in 1981. It was a simple agreement between IBM and the World Bank. IBM had fixed-rate debt but wanted floating-rate exposure. The World Bank had floating-rate debt but wanted fixed-rate certainty. They agreed to swap their interest payments. No principal changed hands, only the interest rate obligations were exchanged. This solved a real economic problem. It allowed both institutions to manage their balance sheet risks. The mechanics were straightforward. Two parties agreed to exchange cash flows based on different interest rate benchmarks. One party paid a fixed rate, the other paid a floating rate tied to LIBOR. The notional amount was the reference value for calculating payments, but no actual loan principal was transferred. This distinction became crucial. The institutional friction appeared immediately. Traditional banking regulators saw these contracts as private agreements. They were negotiated between sophisticated parties. There were no standardized terms. Each swap was custom-tailored. This made them difficult to regulate through existing frameworks. Futures and options traded on exchanges. They had clearinghouses and margin requirements. Swaps existed in a legal gray area. The human consequence was subtle but profound. Corporate treasurers gained new power. They could now hedge risks that previously threatened their companies. Manufacturer could lock in borrowing costs for years. A pension fund could match assets to liabilities. This created a sense of control in an unstable world. The market grew slowly at first. By 1985, the total notional value reached $100 billion. This was still small compared to global bond markets, but the growth trajectory was steep. Each successful transaction created confidence. Banks began acting as intermediaries. They would match counterparties and earn fees. The early participants were mostly blue-chip corporations and sovereign entities. They had strong credit ratings. Default risk seemed minimal. The system appeared self-regulating. Sophisticated parties could manage their own risks. This belief would shape regulatory attitudes for decades. The legal foundation remained uncertain. Were swaps securities? Were they futures contracts? Different courts reached different conclusions. This legal ambiguity created opportunity. Financial innovation outpaced regulatory classification. New products emerged constantly. Currency swaps followed interest rate swaps. Then came equity derivatives and commodity swaps. Each new product solved a specific hedging need. Each also created new complexities. The market remained decentralized. Transactions occurred over the telephone. Confirmations were sent by fax. There was no central registry. No one knew the total size of the market. This opacity would become a defining feature, yet for 20 years the system functioned smoothly. It provided genuine economic utility. Companies could focus on their core businesses. They could hedge financial risks they did not understand. This specialization improved economic efficiency. The shadow was growing, but it still served the light. The regulatory vacuum. By the early 1990s, the derivatives market reached $1 trillion in notional value. Growth accelerated as new players entered. Investment banks created dedicated swap desks. They began warehousing risk themselves. Instead of just matching counterparties, banks started taking positions. They would enter into swaps with clients, then hedge their exposure in other markets. This transformed the business model. Banks became market makers. They provided liquidity and standardized terms. The mechanics of the shift were technical but important. Bank would enter a swap with Corporation A. Corporation A wanted to pay fixed and receive floating. The bank would then enter an offsetting swap with Corporation B. Corporation B wanted to pay floating and receive fixed. In theory, the bank was perfectly hedged. It earned fees from both transactions. But in practice, perfect matches were rare. Banks began running mismatched books. They would aggregate many similar positions, then hedge the net exposure using futures or government bonds. This required sophisticated risk management systems. The institutional friction became apparent. Banking regulators focused on traditional lending. They monitored capital ratios and loan loss reserves. Derivatives existed off balance sheet. They were recorded as contingent liabilities. The notional amounts were enormous, but the actual credit exposure was much smaller. Regulators struggled to measure the true risk. Different accounting standards created confusion. Some countries required mark-to-market valuation. Others used historical cost. This made cross-border comparison impossible. The human consequence was a divergence in expertise. A small group of quants and traders understood the new mathematics. They developed complex pricing models. The Black-Scholes formula for options became famous, but for interest rate swaps, the models were even more intricate. They incorporated yield curve dynamics and credit spreads. This created an information asymmetry. Bank executives often did not understand their own trading desks. Regulators certainly did not. The legal uncertainty reached a critical point in 1998. The Commodity Futures Trading Commission issued a concept release. It questioned whether swaps should be regulated as futures contracts. This threatened the entire market. If swaps were classified as futures, they would need to trade on exchanges. They would require margin and clearing. The customized nature would disappear. The industry mobilized against this threat, and the JAWS, major banks, formed lobbying groups. They argued that swaps were private contracts. They served sophisticated commercial entities. Regulation would drive the business offshore. London and Tokyo would capture the market. This argument resonated in Washington. The political context favored deregulation. The 1990s saw broad financial liberalization. Glass-Steagall restrictions were being dismantled. The Gramm-Leach-Wiley Act allowed commercial and investment banking to merge. Derivatives seemed like the next frontier. The industry proposed a legislative solution. They wanted legal certainty. They wanted swaps explicitly exempted from existing regulations. This effort culminated in the Commodity Futures Modernization Act. The bill was complex and technical. It ran over 200 pages. Buried within it was Section 203. This section contained the critical language. It stated that swaps were not futures contracts. They were not securities. They were excluded from the Commodity Exchange Act. The exemption applied to transactions between eligible contract participants. This term was broadly defined. It included corporations, banks, insurance companies, and wealthy individuals. The bill passed in December 2000. It was signed into law without fanfare. Few outside financial circles noticed. But this single paragraph created the legal foundation for explosive growth. The shadow now had official permission to expand. The architecture of opacity. With legal certainty established, the derivatives market entered its golden age. Between 2000 and 2008, notional values grew exponentially, from $10 trillion to over $600 trillion. This growth was not linear, it was geometric. Each year added more than the entire market of 5 years prior. The mechanics of this expansion reveal the system's architecture. Banks developed new product structures. Credit default swaps emerged as the most significant innovation. These were essentially insurance contracts on corporate bonds. A protection buyer paid periodic premiums. In return, the protection seller promised to pay if a credit event occurred. The reference entity could be a corporation or sovereign. The notional amount represented the bond's face value, but unlike insurance, there was no requirement to own the underlying bond. This created pure speculation. The institutional friction became systemic. Traditional risk management frameworks broke down. Value-at-risk models assumed normal market conditions. They used historical volatility data, but derivatives created non-linear payoffs. Small changes in inputs could produce enormous changes in values. This was the problem of convexity. The human consequence was a psychological shift. Traders began viewing derivatives as profit centers rather than hedging tools. Bonuses were tied to trading revenue. This created incentives to increase volume and complexity. Simple interest rate swaps became collateralized debt obligations. These bundled thousands of mortgages into tranches. Each tranche had different risk characteristics. The models used to price them were extraordinarily complex. They relied on correlation assumptions that had never been tested. The legal structure reinforced opacity. Over-the-counter meant private negotiation. There was no public price discovery. Transactions occurred between dealers. What this? A interdealer broker would quote prices over proprietary screens, but retail investors never saw these quotes. Even institutional clients received different prices from different dealers. This created massive information asymmetry. The documentation became another barrier. The International Swaps and Derivatives Association created master agreements. These ran to hundreds of pages. They covered netting arrangements, collateral requirements, and termination events. Only specialized lawyers could understand them. This documentation created the illusion of safety, but it also made the system fragile. In a crisis, interpreting these contracts would take time. Time was the one commodity markets lacked during panics. The collateral system added another layer of complexity. As derivatives values fluctuated, parties posted collateral. This was usually cash or government securities. The amount was calculated daily using mark-to-market valuations. But these valuations came from the dealer's own models. There was no independent verification. During normal times, this system worked smoothly. Collateral moved back and forth between counterparties, but it created hidden leverage. A bank could post the same government bond as collateral for multiple transactions. This was rehypothecation. The same asset supported multiple obligations. No regulator tracked this practice. The scale became staggering. By 2007, the gross market value of derivatives was $10 trillion. This represented the actual credit exposure after netting, but the notional amount was 60 times larger. This ratio created misunderstanding. Critics pointed to the 600 trillion figure. Defenders noted the much smaller net exposure. Both missed the real risk. It was not the size, but the interconnectedness. Each major bank was counterparty to thousands of transactions. Their failure would trigger a cascade of collateral calls. This network effect was invisible to traditional analysis. The architecture was complete. A shadow financial system operated parallel to the regulated banking sector. It was larger, more complex, and completely opaque. It served real economic functions, but also created new vulnerabilities. The stage was set for a test. The trust erosion. First cracks appeared in 2007. Bear Stearns announced problems in 2 hedge funds. These funds were heavily invested in mortgage-backed securities. They also used credit default swaps for leverage. When mortgage defaults rose, the funds faced margin calls. They could not meet them. Bear Stearns attempted a rescue, but the damage was done. Confidence in complex derivatives began to waver. The mechanics of the unraveling were technical but predictable. Mortgage-backed securities lost value. This triggered losses in collateralized debt obligations, but what probably any those losses affected credit default swap positions. Protection sellers faced payment obligations. Some could not pay. This created doubt about other counterparties. The institutional friction became catastrophic. Banks stopped trusting each other's valuations. If Bank A claimed its derivatives portfolio was worth X, Bank B had no way to verify. The models used different assumptions. The data inputs were proprietary. This created a classic asymmetric information problem. In normal times, banks accepted each other's numbers. In crisis, they assumed the worst. The human consequence was paralysis. Traders could not price transactions. Risk managers could not measure exposure. Executives could not assess their own firm's health. This uncertainty froze the interbank lending market. Banks hoarded cash. They refused to lend even overnight. The LIBOR-OIS spread, a measure of banking stress, widened dramatically. This was the canary in the coal mine. The legal structure designed for safety now created danger. Master agreements contained cross-default provisions. If a counterparty defaulted on one transaction, it could be declared in default on all. This was meant to protect against cherry-picking, but in a crisis, it created a domino effect. A single failure could trigger widespread termination. Each termination required settlement payments. These payments required liquidity, but liquidity was evaporating. The collateral system amplified the stress. As derivatives values moved against banks, they faced margin calls. They needed to post more collateral. But collateral was becoming scarce. High-quality assets like treasury bonds were in demand. Their prices rose, creating a flight to quality. This made it harder for banks to meet calls. Some began liquidating other assets. This pushed prices down further. A vicious cycle began. The loss of trust became visible in specific episodes. In March 2008, Bear Stearns could not roll over its short-term funding. Other banks refused to extend credit. The Federal Reserve arranged an emergency sale to JP Morgan Chase. This was a watershed moment. A major investment bank had failed. Its derivatives portfolio was transferred to a stronger institution, but questions remained. What about other banks? Lehman Brothers was next. Its failure in September 2008 revealed the system's fragility. Lehman had over $600 billion in derivatives contracts. The bankruptcy filing triggered automatic termination. Counterparties rushed to calculate their exposures. The process was chaotic. Some positions were netted, others were not. The legal uncertainty created delays. During those delays, markets froze completely. The American International Group episode showed another dimension. AIG had sold massive amounts of credit default protection. It had collected premiums for years, but it had not reserved adequately for potential payouts. When housing collapsed, AIG faced obligations it could not meet. The government intervened with a $182 billion bailout. This was not to save AIG's shareholders. It was to prevent a derivatives meltdown. AIG's failure would have triggered cascading defaults across the global financial system. Each of these events eroded trust further. Market participants realized they did not understand the risks. They had relied on models that failed. They had trusted counterparties that proved unreliable. They had believed in diversification that turned out to be correlation. The psychological shift was profound. The shadow banking system, built on confidence and complexity, lost both. Yet the size of the market remained enormous. The $600 trillion shadow still existed. It was wounded but not dead. The question became how to rebuild trust, or whether to dismantle the system entirely. The reform impulse. In the aftermath of the crisis, policymakers faced a monumental task. The derivatives market had nearly destroyed the global financial system, yet it also provided essential hedging functions. The challenge was to preserve utility while reducing risk. The Dodd-Frank Act attempted this balancing act. Title VII focused specifically on derivatives. Its core principle was transparency. Over-the-counter derivatives would move to exchanges or swap execution facilities. They would be cleared through central counterparties. This was a fundamental architectural change. The mechanics of clearing were crucial. A central counterparty interposes itself between buyers and sellers. It becomes the buyer to every seller and the seller to every buyer. This mutualization of risk creates a collective buffer. If one party defaults, the clearinghouse uses margin and default funds to cover losses. This prevents cascading failures. The institutional friction appeared immediately. Banks resisted the loss of profitable opacity. Exchange trading meant price transparency. This would compress bid-ask spreads. Dealer profits would decline. Clearing required posting initial and variation margin. This tied up capital that could otherwise be deployed. The human consequence was a migration of activity. Some derivatives business moved to jurisdictions with lighter regulation. London and Singapore gained market share. Other products were redesigned to avoid classification as swaps. Financial engineering found ways around the new rules. The legal implementation proved complex. Regulators wrote thousands of pages of rules. Definitions mattered enormously. What exactly constituted a swap? What made a counterparty commercial versus financial? These determinations affected capital requirements. The cross-border dimension added another layer. If a U.S. bank traded with a European counterparty whose rules applied, this created regulatory arbitrage opportunities. The reform effort achieved partial success. By 2020, approximately 75% of interest rate swaps were cleared. Credit default swaps showed similar rates, but significant segments remained in the shadows. Foreign exchange derivatives largely avoided clearing mandates. They were deemed to have different risk characteristics. The notional amounts remained staggering. Even after reforms, the market exceeded $600 trillion. The architecture had changed, but the scale persisted. The human psychology also evolved. Risk managers incorporated lessons from the crisis. Stress testing became more rigorous. Models included tail risk scenarios. Collateral management received greater attention, but memories faded with time. New generations of traders entered the market. They had not experienced 2008 firsthand. Compensation structures still rewarded short-term profits. The fundamental tension remained unresolved. Derivatives served both hedging and speculation. Regulation could distinguish between the two in theory. In practice, the line was blurry. A corporation hedging currency risk might also take a view on direction. A bank providing liquidity might also build proprietary positions. The system became more transparent but not necessarily safer. Network effects persisted. Major dealers still dominated the market. Their failure would still create systemic risk. Central clearing concentrated risk in clearinghouses. These became too big to fail. They required their own regulatory oversight. This created a new layer of complexity. The reform impulse also faced political headwinds. As the crisis receded, pressure for deregulation returned. Some rules were rolled back. Others were not fully implemented. The industry argued that excessive regulation reduced liquidity. They pointed to declining dealer inventories. This made it harder for end users to hedge. There was truth in both perspectives. Safety required buffers. Buffers had costs. The optimal balance was elusive. By 2025, the system had stabilized. but it had not fundamentally transformed. The $600 trillion shadow still cast its influence. It was better lit, but no less large. The architecture was more robust, but still complex. The lesson of history was clear: financial innovation creates both solutions and vulnerabilities. Regulation follows crisis, but cannot prevent the next one. The cycle continues because human nature remains constant. Greed and fear drive markets. Complexity obscures risk until it materializes. Then the scramble for safety begins anew. The historical pattern. The evolution of hidden derivative markets follows a familiar historical pattern. Financial innovation begins by solving real economic problems. Interest rate swaps allowed corporations to manage uncertainty. This was genuine progress. But innovation creates complexity. Complexity creates opacity. Opacity creates information asymmetry. Those with superior knowledge gain advantage. They resist transparency because it reduces their edge. This dynamic appears throughout financial history. Consider the medieval bill of exchange. It allowed merchants to transfer funds across borders without losing specie. This solved the problem of transporting gold, but bills could be endorsed multiple times. They created chains of credit that were invisible to regulators. When a major trading house failed, the cascade of defaults could collapse entire economies. The pattern repeated with joint stock companies. They pooled capital for large ventures like colonial trade, but limited liability created moral hazard. Directors could take excessive risks with other people's money. South Sea Bubble and Mississippi companies show the consequences. Each innovation brought benefits, but also new vulnerabilities. The cycle has three phases. First, permissionless innovation. Entrepreneurs identify unmet needs. They create financial instruments outside existing regulatory frameworks. Second, explosive growth. The innovation proves useful. Adoption spreads rapidly. Complexity increases as new variations emerge. Third, crisis and reform. A shock reveals hidden risks. Policymakers respond with regulation. The system becomes more transparent but also more rigid. Then the cycle begins again. Derivatives followed this exact path. The 1980s were permissionless innovation. The 2000s were explosive growth. 2008 was the crisis. Dodd-Frank was the reform. Now we are in a new phase. The reforms have been implemented but not fully internalized. The market has adapted but not transformed. The historical insight is that financial systems evolve through punctuated equilibrium. Long periods of stability are interrupted by brief crises. Each crisis leads to regulatory changes, but the changes often address the last crisis rather than preventing the next one. This is not because regulators are incompetent, it is because complexity outpaces understanding. Financial instruments can be engineered faster than rules can be written. The $600 trillion shadow represents this reality. It is the accumulation of decades of innovation, each layer built upon the previous one. No single architect designed the system. It emerged from countless individual decisions. Each made sense in its local context, but collectively they created systemic risk. This pattern appears in other domains. Climate change results from billions of individual emissions decisions. Each seems rational locally but creates global consequences. The internet grew from decentralized protocols. Now it faces challenges of misinformation and security. Complex systems share common characteristics. They are adaptive, nonlinear, and path-dependent. Small changes can have large effects. Prediction is difficult because feedback loops are opaque. The derivatives market exemplifies these traits. Its size alone does not determine risk. The network structure matters more. The connections between institutions create contagion channels. Historical analysis reveals that financial crises are not random events, but they emerge from the interaction of innovation, leverage, and human psychology. Each era has its own specific triggers, but the underlying mechanics are similar. Excessive credit growth precedes most crises. Complexity obscures risk until it is too late. Then trust evaporates rapidly. The derivatives episode offers particular lessons. First, opacity is dangerous in finance. When participants cannot assess counterparty risk, they assume the worst. Second, legal certainty matters. The Commodity Futures Modernization Act created a regulatory vacuum. This allowed exponential growth without adequate safeguards. Third, network effects can amplify shocks. Interconnectedness creates resilience in normal times, but fragility in crises. These insights are not new. They echo observations from previous financial eras. What changes is the technology, not the human behavior. The $600 trillion shadow will eventually be replaced by another innovation, perhaps decentralized finance using blockchain, or artificial intelligence-driven trading strategies, but each will solve current problems but create new ones. The historical pattern suggests that the next crisis will emerge from an unexpected quarter. It will involve instruments we currently consider safe. It will be amplified by connections we do not fully understand. This is not pessimism but realism. Financial systems evolve. Risk migrates to the least regulated areas. Regulation follows but always lags. And in the EQR, the cycle continues because it serves human needs. We want both innovation and stability. We want growth without risk. These desires are in tension. History of derivatives shows that we cannot have both completely. We can only manage the trade-off more intelligently. This requires humility about what we can know. It requires vigilance about what we cannot see. And it requires memory of what has happened before. The $600 trillion shadow is not an aberration. It is the latest manifestation of an ancient pattern. Understanding this pattern does not prevent future crises, but it might help us navigate them with less damage. That is the value of financial history. Not prediction, but perspective. Not certainty, but context. The shadows will always be with us. The question is whether we learn to see in the dark.